you don't have to be a sophisticated investor to look at these things. Okay. It just takes a little bit of education on your part to be able to do proper due diligence on these investments. And once you've done that, now it's time to learn, through that process of taking that next step.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying the show and getting some great value for your investing goals, let us hear about it and leave us an honest rating and review. It helps us. It also helps other listeners find this show for their investing goals. Now, listen, if this is your first time listening to the show, or you just haven't done so for some reason, be sure to hit that follow or subscribe button so you don't miss an episode. We got a great show today. We're going to be talking to Jeremy Dyer. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Now, Jeremy Dyer is the founder and managing partner of Starting Point Capital. Now, Jeremy leads the company's investor relations, strategic partnerships, and serves as the director of marketing for the company. Now, when investing in real estate, you're putting your faith and trust into the competence, credibility, and effectiveness of the sponsors. And this is exactly what Jeremy and his team look to do. They have extensive experience in real estate, both as active and passive investors. And currently, Jeremy is a passive limited partner in over 4,000 multifamily doors, 24 passive real estate deals, and over $400 million in total assets. Let's welcome to the show, Jeremy Dyer.
John, thank you so much for having me. Looking forward to it.
Absolutely. Jeremy, I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, sounds good. Be happy to do that. So, my real estate journey really started as a actually a high performance sales professional in technology space that afforded me the ability to have some excess cash sitting on the sidelines after I had paid off my dream home, maxed out the 401k. My wife stopped working, when my first of 4 children was born. So we really got bored and decided, you know what, I really like real estate. Let's find some single family homes to throw some cash at, fix and flip and see how we do, because that's what the sexy HGTV show sort of showed us we could do. So we really got started in real estate really after the global financial crisis, where a lot of single family homes, were not just operationally distressed, but there was some financial distress. The basis was down. And it was really a good time for us to get, into the space. The challenge was, John, is in 2015, my wife and I decided to double down on kids. We went from 2 kids to 4 kids. I was still, crushing my W-2, year in and year out, crushing those sales goals. And I told my wife one day, I said, honey, there's no way that I'm going to be able to continue to ride 2 horses at the same time. There's no way that I can continue, to crush my sales performance goals year over year, build up a growing at the time, single family home portfolio and be a good husband and a father to 4, because my older boys at the time were also involved in year-round hockey, and they wanted me to be their coach. So it was one of those things, John, where we decided in 2015 to exit out of the active side of real estate ownership on the fix and flip side and decided to go passive. If you had asked me back in 2015 what the word, syndication meant, my response to you would have been, well, the Green Bay Packers are a syndicated football team, right? Yes. Okay. So I didn't realize that there was an opportunity at the time to invest passively into real estate. And so it was really in 2015 that we got started. Quite truthfully, we used a shotgun approach, and I held my breath and I plugged my nose and I sent that wire transfer, into the operator, kind of hoping for the best. And fortunately, that proved itself to be lucrative enough for us to want to continue. And so, thank you for reading my bio there. I'm actually in 31 passive real estate investment deals right now as a limited partner. And a couple of years ago, I founded a private equity company by the name of Starting Point Capital with the original plan of just purely to educate my personal and professional network with the benefits that I've been receiving through passive real estate investing and its ability to allow me to replace the dependence on my W-2 paycheck. However, what ended up happening with Starting Point Capital is we had such a community of investors all coming together wanting to deploy capital into opportunities that my wife and I were choosing to deploy our capital into, that we found ourselves in a leveraged position with the sponsor. So not only were we able to leverage the collective group of investors in doing our own due diligence on these opportunities, but we were also able to receive a better investor return profile with the sponsor because we were coming into those opportunities again as a group of investors deploying our capital.
I love it, man. Great information. You talked about starting out, really, you crushed in your day job. And it, I think oftentimes that gets overlooked in these conversations, but you've got to have a starting place. And for you, it was doing really well in your day job. You maxed out the 401k, paid off your home, retired your wife where she could stay home and be a stay-at-home mom. And from there, you said, okay, I've checked these boxes, right? I've done the foundational things. Now, what do I want to do? You start investing in single family homes, which again, people tell you to invest in real estate, makes sense. Single family homes is where you started. But as you grew your business and grew your family, I should say, grew your career and grew your family, and then yes, your business with the single family homes, you realize there's a lot. It's a lot to stay on, right? And try to manage all those different things. And that's what warmed you up to investing passively. You talked about being in 31 syndication deals and ultimately being able to create starting point capital. And with starting point capital, you're able to bring your friends and family and other folks into this space so they can get the same kind of returns that you were getting through these deals. I want to go back to your introduction to syndication because you mentioned that, hey, if you would have told me what syndication was, I certainly didn't have any idea what it was. And it's funny because for me, I come from advertising and marketing as a background. So if you were to ask me what syndication was, I was like, oh, that's when a TV show has reached 5 seasons and now it can get shown, all across the country at different times of the day. So to your point, the syndication thing is still a relatively new thing for many people. You mentioned that you kind of pinched your nose and kind of just went forward and hope for the best. I'm sure you talk to people who are maybe concerned, have some trepidation about taking that step. Maybe this sounds too good to be true. As you look back, even going back to 2015 when you kind of got into the space, and obviously you've been in it for 9 or 10 years at this point. But when you're talking to somebody who's looking to invest for the first time, what's the major hurdle or the major obstacle that they've got to get over to feel comfortable making that investment?
Yeah, it's a great question. And I would say everybody's got kind of different reasons why they're apprehensive to invest. I mean, that's true in Wall Street, just the same it is as it is in investing in Main Street. A lot of our investors are franchise owners, and I'm sure they have to get past their analysis paralysis before they decide to deploy capital into franchise ownership, right? The same thing exists, as it relates to the advice we get from our financial advisors, certainly exists in the world of syndication investments and private placement investing as well. So it's really my advice for all investors, whether they're novice or they feel experienced or sophisticated in the space, is really to further continue your education, which is why I love podcasts. People always ask me, how did you go from 0 miles an hour to 100 miles an hour in the syndication investing space in such a short period of time? And I tell them it's because I have earbuds in my ears, all throughout the day. Whenever there's downtime in my schedule, I'm constantly learning, right? I'm learning from people like John, okay? I'm learning from other people that are in the space today to continue to further my education and really have a pulse, on where the market is, right now. But once you've got the education, once you've aligned yourself with a best in class sponsor, more information on that, of course, I think to follow in this episode. But once you've got your education, you've got your goals aligned, you've got your financial house in order, now it's time to start taking action. And I would say one of the biggest challenges to people growing their wealth building trajectory is they just never get, they never get out of the starting blocks. They never get off of the bench and into the starting lineup, so to speak, right? So eventually you've got to start taking action. And that's one of the things that I was, blessed to have been able to do, back in 2015 when I deployed that first wire transfer into that first syndication, is that really allowed me to learn through the process, right? Certainly there's risks involved, but as long as you are educated, you understand what you're doing, you've aligned yourself with a best in class sponsor, and you've done your own due diligence, whether that be stress testing the financials or, looking at some of the assumptions or sensitivity analyses, right? You don't have to be a sophisticated investor to look at these things, okay? It just takes a little bit of education on your part to be able to do proper due diligence on these investments. And once you've done that, now it's time to learn, through that process of taking that next step.
Yeah, I like how you talked about getting out of the starting box and just understanding that you have to educate yourself. And that's the biggest thing, right? That apprehension or hesitation, it comes from just not feeling comfortable. And some of that comfort is because you just don't know what you don't know. But some of that is because you just haven't spent enough time learning about the space and educating yourself. So listen to the podcast, read the books, attend the meetings, network, talk to other folks in the space, get as comfortable as you can get. With that said, you're still going to be somewhat uncomfortable on that first deal. Like I don't think there's enough hours in your life to be 100% comfortable and confident on that first deal. So you do have to take a little bit of a leap of faith, but you can reduce and mitigate some of those risks by doing the things that you just talked about, Jeremy. So again, getting to know operators, asking the right questions, educating yourself is absolutely key. You mentioned that you got comfortable in that first deal primarily through the education process. What concerns did you have? What were kind of the things that were still open and the known unknowns, if you will, going into that deal? I mean, you in my head, I'm picturing you pinching your nose, right, and saying, "Okay, I'm gonna hit the send button on this wire and just pray that it goes well." But I think sometimes we don't give ourselves enough credit for all the work you do. I'm sure you did a ton of research going into it, but you also probably knew, hey, there are a couple things that I just don't know, or maybe I should have asked a better questions as you went into that deal. Give me some of that feedback.
Yeah, no, that you're hitting on the most important thing here, and that is our apprehension on the team that's actually managing the business plan. Okay. I don't care if it's a build to rent opportunity, it's a bunch of single family home, properties as part of a portfolio, if it's a value add, multifamily, B class syndication, right? Whatever it is, right? It even could be, an angel investment, right? That you make. It all comes down to the operator and the team that that lead sponsor or that lead operator is surrounded with. Okay. It's not about the glossy pitch deck. Okay. It's not even about the actual property itself or even the business plan for that matter. It all comes down to who is that operator, who is that airline pilot that is going to get us from point A to point B. And the unfortunate thing or the challenging thing I would say in this space is it's very difficult to properly vet out a sponsor, a lead syndication team, unless you've actually personally invested your own money with them in the past. It's one thing to reach out to a reference or to look at their track record, which the track record doesn't always repeat itself, right? Because we don't have a crystal ball, right? But it's another thing to really seriously get down and dirty with that sponsor and ask them some very tough questions. Tough questions are related to, their underwriting assumptions, right? Their projected rent growth assumptions. Let's talk about your past deals. Yeah, you might have a great track record, but let's talk about those deals that you purchased in 2021 and early 2022 when everybody was running into the fire when they should have been running out of the fire, right? That time period in real estate investing felt a lot like back when I was in college during the dot-com bubble burst days, right? It's like everybody was, speculating, running into the market, right? Sponsors were putting offers on properties and they were the 17th out of 50 bidders, right? There was mass hysteria during that time. Let's really talk and address, those types of topics. Let's talk about, sponsors that maybe have deals that are financially distressed right now. Maybe their debt service coverage ratio is below 1.25, which I would argue is relatively healthy. Anything above that line, below that line, no, right? Where is their focus going to be on this next investment that you're asking for me to deploy 50 or $100,000 of my own hard-earned money into that deal? How focused are you going to be on this new investment that you're asking for me and my investors to partner with you on when you have six other deals right now that you're struggling to maintain enough liquidity in those properties in order to keep the lights on? Does that make sense?
Absolutely. I think it's great questions to ask, right? And what you're getting at here is first and foremost, it's one thing to analyze everything into an offering memorandum, right? Or a pitch deck. It's another thing to understand who the team is, and focusing on the team is absolutely critical. And that's one of the things that you've learned in your time, and most people learn over time, is that it's all about the team. Yes, you want to have a good business plan. Yes, you want to have a great building or a great property or project to take on. Yes, you want to be in a good market. But if you have the right team, they will know how to navigate all those other components. That's what they're there for. So having the right team is key. And having a good team isn't just about their track record. In every offer, in every investment, there's usually a disclaimer that says past performance does not indicate future performance. That disclaimer is there for a reason, right? So you definitely want to understand what drove some of those decisions. Recently, we had Joe Fairless back on the show, and Joe said one of the things that he does as an LP investor, he's both an active and LP investor, but he says he likes to pay attention to NOI growth. So when he's looking at the past performance of deals, did you make money and crush it just because you bought it at a five cap and sold it at a four cap? Or did you actually implement the business plan, drive the NOI growth, and control the controllable components of that deal? So there's definitely some nuanced things we could get into that help us as investors make the right decisions on vetting those operators. But I like the mindset of making sure that one, you've got to invest with these groups to really know outside of you investing, then obviously really understanding that track record, talking to folks who've invested with them, and then paying attention to the deals they've done, particularly in that 2021 to 2022 timeframe where that market shifted and a lot of those fundamentals changed. So that really put a lot of operators into a difficult position. You mentioned something that I want to come back to, and you talked about best in class sponsors. One, I want you to define that for our listeners from your standpoint. What do you consider a best in class sponsor, and how do you seek those individuals out?
Yeah, absolutely. I'll maybe start with the end part of that. How you find best in class sponsors is you have to network, right? The cliche saying goes, your network is your net worth kind of a thing, right? You really have to find out who those best in class sponsors that are out there in the space today. The truth is that there are best in class sponsors that are teams of 2, 20, and 400, right? They're just out there, right? The challenge is how do you identify which of those are best in class, right? And that's challenging for a novice investor, somebody that's not currently in the space today, somebody that is laser focused on, crushing their performance at their day job, running their kids around to soccer practices, but just doesn't have enough discretionary, time or disposable time in their day to be able to identify who these sponsors are. Okay. LinkedIn is certainly a great place to find them, right? But also showing up to networking events or talking to people like John and myself who have experience in identifying who those best in class sponsors are that we would feel comfortable deploying our own capital into. So a big part of it is just simply networking to get to know who's in the space. When it comes to what defines a best in class sponsor, really it comes down to it's not a trust thing, okay? And I'll tell you why. There's a lot of people that I trust, John, but there's not a lot of people that I would trust in managing $100,000 of my money, right? So what do you do? Okay. Track record is definitely a key indicator, okay, of potential future performance, but the past doesn't always repeat itself. So I would always encourage, investors to let's take a look at the track record. Let's take a look at deals that have gone full cycle. But beyond that, let's take a look at, like I had mentioned before, let's take a look at a time period where there was some economic headwinds, okay, when there were some challenges facing the deal, okay. 2021 and 2022 are great examples of that. What type of debt structure did you take on those loans? Were you over leveraged, right? Were those floating rate bridge loans? Did you have a rate cap? Did you purchase a rate cap, right? Did you have enough liquidity, built in on the front end of those opportunities, for a rainy day event, reserves, those types of things to be able to afford potentially extending that rate cap into years 4 and years 5? There's a number of different things that you can look at to identify during the latest economic cycle where sponsors had some distress. What did they do about it? And how transparent, John, were they with their investors? There's sponsors in the space today that communicate monthly. They provide all the financials, access to the bank statements, the underwriting details, the balance sheet, the general ledger. Okay, they give investors access to the same information that they're providing the senior lender in the deal, which is, by the way, the largest investor in most cases, right? So are they giving investors that level of transparency on a monthly basis, quarterly basis, or is it, less frequent than that? I'm a big supporter of sponsors that provide their investors with full access, full transparency, and they communicate with them, on a monthly basis. Second to that, it really comes down to their operations, right? I personally prefer to deploy capital with operators that are vertically integrated on both the property management side and the building construction side. Why? Because I want to partner with an operator that has full control from acquisition of the asset all the way through disposition, right? It's very difficult for operators that use third parties, okay, that may have a bad Apple employee or two, and then they end up having to terminate that relationship with that third party operator or building construction company and then replace them with a whole nother management company. That's a big challenge for a lot of operators, and it can be a major disruption in their business plan.
Great stuff right there. You just gave a few things that I want our listeners to kind of go back and listen to. First of all, you started by saying, hey, how do you find these individuals? Certainly you go online, social media, LinkedIn's a great platform, but networking is going to be the biggest thing you can do. Talk to people, get out there, ask questions, and get to know operators. A couple things you're looking for. One is track record, not just, hey, how many deals have you done? How many have gone full cycles? What are the returns your investors have received? But understanding how they handle those economic headwinds, challenges in those deals. What assumptions did they make? What did they learn from those deals and those challenges? That's really what you're trying to understand. How do they communicate? Are they transparent? Do they give you access to data, access to the bank statements, access to the financials? Is this something that you can pick up the phone and call them? If they email or text them, are they going to respond or do they duck you? That's something I just can never understand how anyone could get in this space and not be accessible. It really bothers me if you get people to believe in you and they invest their money with you and you won't return their phone calls or their text messages. It's crazy whenever I hear those kind of stories. And then last is about the operations, right? You talked about being vertically integrated. Your preference is looking for companies that are vertically integrated. They control all aspects of property management, of development, and that's something that's really important to you. Um, I love that. I think it's just really important to just process your approach and understand that, hey, this is the thing, these are the things that you've learned. And this allows you to be a great LP investor, knowing exactly what it is you look for. I want to flip the script, right? Because I think a lot of times as LP investors, people assume the conversation should be one sided, right? I'm interviewing you as an operator. Prove to me why I should invest my money with you. And certainly there's a component where you have to feel comfortable. But if you're on the other side of that table, what should operators be looking for in a great limited partner?
Yeah, that's a great question. I would say the biggest one is that they have to have a level of confidence that that LP investor has enough knowledge to make an educated decision as opposed to an emotional decision. Okay. I, for example, regularly communicate with net new limited partner investors. The name of my company is called Starting Point Capital for a reason. Okay. It is the starting point for busy professionals to get involved in real estate investing on the passive side, not on the active side. And I encourage all investors, please do not take my word for this. Okay, I'm going to walk through the business plan. I'm going to talk about the projected returns and the targeted returns, and I can answer questions for you. But I don't want you to take my word for this. I want you to do your own due diligence. How do you do that? You have to get educated. Okay, I'm a big supporter of Brian Burke's book, The Hands-Off Investor. I had Brian on my own podcast a number of months ago, and I joked with Brian. I says, I've sold 1,000 copies of your book and have not received the diamond royalty yet. I suggest that's a great place for people to start to learn about the basics of passive real estate investing, right? In the lens of doing it on the passive side, not on the active side. Brian does a great job explaining to the readers why it's of utmost importance to vet the operator as opposed to just simply betting the deal. So when it comes to having the shoe on the other foot, my advice as a sponsor to a limited partner is you've got to do your own due diligence. And a big part of that is you have to continue your education. Okay. It's all about you getting educated to the point you, in terms of you understanding the type of investment that you're making, the risks associated with investing, using this type of a strategy, and that's the advice that I'd take away for you there, John.
I love it. That's really great intel. And I second it completely. It's all about education and making sure that you are well informed to make a decision. And to put it a little bit differently, I tell people all the time that you never want to, convince someone or get somebody to just make a decision because they're so excited without really comprehending the investment, because this is not a small commitment. I mean, we're talking typically $50,000 is the minimum investment of most of our deals, and I'm sure many of the deals you see as well. That's not a small amount of capital. So make sure that people understand the time frame of the expectation of the investment, the return expectations, the potential risk, and that they are comfortable making this decision. This is not the time to sell or convince or persuade. You know, the only thing you want to do is educate, provide information, provide examples, be a resource for individuals, but you certainly don't want to convince someone to invest or help them make an emotional decision. So that's really important. I love the fact that you called that out, because you want people to be in the right mindset and also to take their own accountability for the decision for what they're doing, because ultimately we're trying to help people with their financial future, and they're the ones at the forefront of that. So that's a big important aspect of what we're trying to do here. I want to go back, Jeremy, because, as you talked about your experiences, I think you said 31 syndication deals that you're in right now. Just based on the number, I imagine you have some deals that are absolutely crushing it and well beyond pro forma expectations, many of which you are performing within the guidelines or the expectations that you were expecting, and some that may not be performing pretty well at all. As you look at that portfolio, what lessons or insights would you share with our audience as far as any similarities between those deals that are struggling, or between the deals that are absolutely crushing it?
Yeah, no, it's a fair question. And really the deals that are having challenges right now aren't on the operations side of the business. It's not on the execution of the business plan. It's literally just a debt problem. Okay. That's what you're going to find over the course of the last, 60 months is deals that purchased during that, time period that have distress now. More than likely, it's not on the operations side, it's on the debt structure side, the financial side. And so the deals that I'm in personally, I've had three deals, John, that have had capital calls that I have chosen to participate in all three capital calls. The one similarity between all three of those opportunities is they were all acquired in 2021 with floating rate bridge loans. Okay. So the question then for the LP investor, number one, if you've not invested before, as a passive real estate investor, you've got to understand what a cash call or capital call is, and if you choose to or not choose to participate, in that cash call, what that looks like for your original investment. But, I have a very basic, level criteria, that I use when deciding whether or not I'm going to participate or not in that capital call. And it really comes down to what is the sponsor doing to provide some additional skin in the game, right? Are they choosing to suspend, their asset management fee? Are they willing to give up a percentage of their general partnership share in that investment opportunity? This new capital that I'm bringing to the project, what is the new business plan? Because the old business plan didn't work. Okay. So what's the new business plan on the new capital that I'm choosing to deploy, into this opportunity? And at the end of the day, do I have confidence in that specific sponsor's ability in the lens of what has happened in the past? Am I confident in that specific investment sponsor's, business plan and team to be able to execute on that new business plan?
I appreciate you sharing that. And I've got two more questions, but sticking to the capital call, you mentioned that, hey, you've chosen to participate in these capital calls. It really comes down to one, understanding, hey, what changes economically for you as the investor? Is the sponsor giving us some equity? Is there some sort of economic shift that makes it worthwhile for you? The second thing you talked about is obviously what's the change? What's the plan? Clearly, what we came into this with wasn't sufficient. So if we need more money, how are those funds going to be leveraged and utilized? And what's different in the execution here than maybe what we initially thought? And then ultimately, it all comes down to your level of confidence with the operator on the execution. And those are the things you're looking at and making that decision. There's some folks who have not really, familiar with the capital call. They don't know if you have to participate, if it's an option, what percentage of people that need to participate, what happens if you don't reach that. Would you mind just at a high level sharing what it's like in a capital call and how that works?
Yeah, I'll try to fill in a little bit more gaps. There's a lot we could talk about and unpack here, but at the end of the day, if an investor chooses not to participate in a capital call, they do run the risk of some share dilution, right? And again, I would refer the investor to the operating agreement to determine, what that looks like should they choose or not choose to participate in the capital call, because that language exists within the confines of those subscription documents that the investor executes at the time that they move forward with that business decision. But beyond that, the other challenge is if a sponsor is unsuccessful, okay, at raising additional capital to pump liquidity, into the deal, they do run the risk of potentially losing the deal, right? And not having enough, capital in to perform perhaps maybe a cash in refinance, right? Or build up enough operating capital in order to be able to sustain, the debt service payments to the bank. So there's a number of different scenarios that operators can exercise in order to, kind of quote unquote keep the deal alive, right? But in most cases, they simply will not be able to manage that unless they have enough commitment from their existing limited partner investor base in order to be able to provide the required amount of liquidity into the deal in order for the senior lender to continue to allow them to manage that property versus running the risk of a potential foreclosure.
I appreciate you sharing that. You mentioned that the three on those three deals, one similarity, they all have floating rate debt. I know some investors, some very seasoned, experienced investors, have flat out, said they will not use any floating rate debt and just, decry it as a bad thing. Um, what's your take on that?
Yeah, it's a wonderful question. And the answer really is it comes down to the business plan, right? If you're investing in a value add project where the projected hold period is 2 to 5 years or 3 to 5 years, it may not be a good idea to secure agency financing with a 7 year fixed interest rate. Why? Because if you fully renovate 100% of those units after, 18 to 24 months, and you now are in a position where you could sell that property and 2x your investor's capital, but there's still 5 years left on the loan, there's something called yield maintenance or defeasance, right? Effectively, the bank is going to require you to pay, that delta or that spread, between that 2 year and 7 year, interest on that bank debt or financing. So, number one, it kind of depends upon what your business plan is in terms of what type of debt structure, is right for you. But the other, side of that is that you've got sponsors in the space today that, you know, depending upon the business plan, it might make sense for them to secure, maybe more long-term agency financing. But if they feel like there's an opportunity to exit out of that deal and rinse and repeat the strategy with another property down the road, it's probably best if they stick to a floating rate bridge loan, but be sure that you're building enough liquidity on the front end in order to be able to afford extending that loan into years 4 and years 5. In addition to that, raising enough capital on the front end to be able to buy down your interest rate. You can effectively engineer and manufacture your own fixed rate loan, even though it might be a 3 year, bridge loan, for example. You can actually manufacture a fixed rate or engineer a fixed rate over that 3 year period as well. And those are all different options that sponsors really have at their disposal, depending upon which financial institution or bank or senior lender they're working with.
Yeah, Jeremy, I appreciate you sharing that because I think ultimately it comes down to the business plan and you have to have the right loan product for the business plan. But based on the risk within the business plan, you need more cushion in regards to reserves or capital or liquidity and things like that. So I think I cringe sometimes when I hear people say like, oh, you should never use floating rate debt. It's like I've also been on the flip side of that where we crushed a deal in 2 years. We had a 7 year fixed rate and we literally couldn't sell the property because we were facing a high six-figure prepayment penalty. If we were to sell, we had to hold it another 2 years just for that prepayment penalty to come down. So there's certainly, you know, strategies that make sense. And obviously, when you get burned by something, it's easy to blame the loan. But really, it should be taken in totality of the business plan, and obviously, the risk should be weighed accordingly. Great information, Jeremy. I mean, you just got just the depth and great information as far as your knowledge here in the space. I know a lot of folks might want to learn more and check you out. They can go to your website, startingpointcapital.com, learn more there. Right now, we're going to transition to our round of insights. Jeremy, give me a failure or an apparent failure that set you up for later success.
Yeah, I would say I may have somewhat alluded to this before, but it was during the dot-com bubble burst days. I was in college and I was buying and selling stocks as a day trader. Where it got real exciting for me is when I started using my college tuition to day trade stocks and then further on margin. So as the bubble started to burst, so to speak, not only was I losing money, but I was losing my college tuition, and those losses were amplified because I was trading stocks on margin.
Wow, that's tough. All right. Give me the digital or mobile resource you recommend for your business.
Yeah, I'm a big fan of LinkedIn. I really like to promote and engage with people, on that platform. I try to post 3 to 5 times, per week. I try to engage with other folks that are also, out in that space. And there's one app that I recently learned about called Anchored Up. Anchored Up allows me to effectively go back into the archives and repurpose old posts or recycle old posts and drag them forward in a very short, limited, period of time. Anchored Up also allows you to, repurpose the content in a way that's going to be the most captivating to the reader. And then it also helps to improve, what we're all seeking to achieve, and that is to figure out the LinkedIn algorithms. So it allows you to really repurpose that content and the video or the still picture in a way that allows you to achieve the most amount of impressions.
Give me the book you've recommended or gifted the most in the last year.
I mentioned this before, The Hands-Off Investor by Brian Burke. But second to that, the next book that I will start to recommend is my own. I'm 45 days away from publishing my own book called The Fundamental Investor. Again, that is The Fundamental Investor.
Love it. We'll make sure we link to that in the pre-order in our show notes there. All right, give me a daily habit that helps you stay focused on your goals.
Yeah, it's actually a physical habit. So I am addicted to running. I have run many marathons over my lifetime. I'm no longer in the marathon game any longer, but I still like to run 4, 5, 6 days a week. That really allows me to kind of set my focus for the day. I try to keep the earbuds out of my ears while I'm running because, again, it allows me to really focus and think about what's important, in front of me today. What are the things that I want to get accomplished today, and what are the steps that I'm going to need to take today in order to, further my progress.
Give me your number one insight for investing as a limited partner.
We kind of talked about this a lot before. The biggest insight is education, beyond the fact that we've kind of drilled down that point. Get your own personal financial, house in order, prioritize the importance of investing in the operator, not in the business plan, not in the pitch deck, and really at the end of the day, once you've done your own due diligence, you've got confidence, you feel comfortable, it's really time to take action.
All right. Great. You gave us some great information there. You are based in Minneapolis. Give me your favorite place to grab a bite to eat.
Yeah, great question. Thanks for the question there. Unfortunately, just this past week, I was able to visit this establishment. The name is called Butcher's Tail. So for those that are listening to this and are familiar with the Minneapolis restaurant scene, there's a restaurant here called Butcher's Tail. The best thing on the menu is by far the beef ribs and the hot Brussels sprouts.
Oh, sounds amazing. Butcher's Tail it is. Jeremy, great information. Really enjoyed talking to you today, hearing about your journey into this space, crushing in the high-tech sales space, growing your family, getting a single family residential side, and ultimately deciding to make that transition to be a passive investor and giving us great insights on what it takes to be successful in that space, helping out other people with your startingpointcapital.com business, and really just, again, helping us learn how to vet operators. For folks that want to learn more, they can check out your website, startingpointcapital.com. I do have one little follow-up, Jeremy, just, in listening to your journey. There's somebody listening right now who is listening to scale their real estate portfolio and doing so actively. You mentioned that you made that transition to decide to let go of your active portfolio to be a passive investor. For that process, that decision, I know you mentioned that your sons wanted you to coach, and you were looking to make sure you were still thriving, kind of the main job. For that person who's maybe in that situation where they've got a day job, they've got this portfolio they've been trying to grow. Most people get into real estate because they want to have financial freedom and spend more time with their loved ones, and they find themselves just working a lot harder trying to juggle both. What would you tell them about investing as a limited partner as opposed to trying to be an active and doing it all themselves?
Yeah, for me, it really came down to priorities. Do I prioritize a six-figure paycheck? Do I prioritize, building up a real estate portfolio? Do I prioritize, being a good husband and being a good father, right? So you really have, and those things change all the time, right? Your priorities in your 20s are going to be different than in your 40s and your 60s, right? So it's really kind of calibrating, what's important to you, right? what is important to you? What should you be focusing your time on? And for me, at that stage in my life, uh, I had to let something go. And the thing that I had to let go is my active real estate ownership. And I had to make that decision to go completely passive in order so that I would have enough bandwidth in my life to, spend time with my, dating my wife once a week and spending time, on the ice with my, youth boys that were playing hockey, year round at that time, right? So I think for each investor, that's going to look a little bit different. But I think what's important is that we all only have so many hours in a day, so many days in a week, and so many weeks in a year. And you really need to make sure that you're focusing on, what's important to you now. And it's not just always chasing after a paycheck. It's not always just chasing after a bigger, real estate portfolio. And being an LP investor has allowed me to really take control of my time, which is the most precious, commodity that we have.
Jeremy, I love it. And I thank you for sharing that with our audience. Someone I know needed to hear that today. So I appreciate you sharing a little bit more about your journey. Jeremy, we look forward to staying in touch with you, and I hope you have a great day.